Financial discipline is not a rule someone writes for you. It is a principle you choose for yourself. It is not about being stingy or living in scarcity. It is about living and working with a sense of purpose for every single decision involving money. In business, this principle becomes even more critical because every choice has a ripple effect. The way you handle your resources today determines the strength of your business tomorrow. Too many entrepreneurs think financial discipline is just about cutting costs, reducing expenses, and being careful. But that is only a small fraction of the picture. True financial discipline is about alignment. Alignment between your money and your mission, between your spending and your long-term vision, between your profits and your purpose. It is about asking before every major decision, does this serve the bigger plan? You see money as a tool. Like any tool, it can build or destroy depending on who holds it and how they use it. Without discipline, money has a way of slipping through your fingers. It disappears into areas that feel urgent but are not important. You may spend on things that make you look successful, but do not make you truly successful. Financial discipline demands that you resist that temptation. It asks you to build a habit of evaluating every expense and every investment, not only for its immediate benefit, but for its long-term return. And that is where many businesses fail. They think in days and weeks when they should be thinking in years and decades. In the early days of a business, discipline may feel like a restriction. You want to expand faster, spend more, upgrade sooner. You see competitors upgrading their offices, buying new equipment, hiring big teams, and you feel the urge to match them. But here is the truth: the market does not reward speed without strategy. The market rewards longevity, and longevity is the product of discipline, your ability to say no to what you cannot afford right now, your willingness to delay gratification, your focus on stability over appearance. That is what keeps your business alive long enough to succeed. Financial discipline also requires you to know your numbers intimately. You cannot be disciplined with something you do not understand. You must know what it costs to run your business, where the money comes from, where it goes, and how much of it is actually working for you. This means developing the habit of regular reviews, checking your statements, studying your cash flow, and asking yourself tough questions about unnecessary leakage. Every business has hidden drains, subscriptions no one uses, projects that bring no return, purchases that felt good in the moment but added no real value. Financial discipline shines a light on those drains and plugs them before they become fatal. Another part of understanding financial discipline is realizing that it is not only about what you spend, it is also about what you keep. Too many businesses operate on the edge, spending everything they make with nothing left in reserve. They survive only as long as sales keep coming in at the same pace. The moment there is a slowdown, they collapse. True financial discipline means you protect a portion of your income, no matter how small, to act as a safety net. This reserve buys you time when the market changes, when customers delay payments, or when unexpected costs arise. That time can mean the difference between closing your doors and weathering the storm. And then there is the mindset shift. Financial discipline is not something you practice only when times are hard. It is something you carry with you in every season. When money is flowing abundantly, discipline keeps you from wasting it. When money is tight, discipline keeps you from panicking and making desperate moves. This consistency builds trust, not only with yourself, but also with your team, your investors, and your customers. People trust leaders who can manage resources wisely. They feel secure knowing the business is in the hands of someone who does not let short-term emotions dictate long-term strategies. At its core, financial discipline is a daily practice. It is the decision to run your business like a steward, not a gambler. It is the willingness to be patient when the world tells you to rush, to be cautious when others are reckless, and to think ahead when others are thinking only about today. It is the understanding that success is not about how much you can spend, but how effectively you can use what you have to create something that lasts. Cash flow is the heartbeat of a business. Without it, no matter how innovative your product is, no matter how passionate your vision is, your business will eventually run out of breath. Many entrepreneurs believe that profit alone is the measure of success, but profit is a number on paper. Cash flow is real. It is the actual movement of money in and out of your business. You can show a profit in your reports while your bank account is empty, and an empty bank account cannot pay employees, suppliers, or rent. This is why controlled cash flow is not just important, it is survival. Controlled cash flow means you are not leaving your financial health to chance. It means you know exactly when money is coming in, how much is going out, and where every dollar, rupee, or euro is going to land. It is the discipline of keeping inflow and outflow in balance so your business is never in a position where you are scrambling to pay bills or taking desperate measures to stay afloat. This control is not built overnight. It is built through consistent tracking, honest assessment, and the courage to make adjustments when the numbers tell you something uncomfortable. Many business owners fall into the trap of thinking that more sales automatically mean more financial stability. But without controlled cash flow, more sales can actually create more problems. Imagine selling a large order to a client who takes 90 days to pay while your suppliers demand payment in 30 days. You might have made a big sale, but in the meantime, you are out of cash. Controlled cash flow means planning for these gaps, negotiating payment terms, and making sure your commitments align with your ability to fulfill them without putting your business in danger. The real power of controlled cash flow is that it gives you choices. When you have money available and you know how long it will last, you can make decisions based on opportunity rather than desperation. You can invest in equipment that will increase efficiency, launch a new marketing campaign, or hire talent that will drive growth, all without risking the basic functions of your business. Without control, you are forced to react to emergencies instead of creating opportunities. Another truth about cash flow is that it is deeply tied to timing. A disciplined business understands its cycles. It knows when revenue peaks and when it dips. It prepares for slow seasons by building reserves during strong months. This is where many undisciplined businesses fail. They treat the good months as a license to spend more instead of a chance to strengthen their financial position. Controlled cash flow means you respect the rhythm of your business and plan ahead for both the highs and the lows. A critical element of controlling cash flow is managing expenses with the same attention you give to revenue. Many entrepreneurs put all their energy into bringing in more sales but neglect to control what is going out. Even small, unnecessary expenses add up over time and can erode your ability to reinvest in the business. Controlled cash flow requires you to question every expense. Is this necessary? Is there a better, cheaper, or more efficient way to get the same result? If the answer is no, it is a sign that money is being wasted, and waste is the enemy of control. Cash flow control also builds resilience. Every business will face challenges, an economic downturn, a sudden loss of a major client, an unexpected market shift. When cash flow is monitored and managed, you are not caught off guard. You have the liquidity to respond strategically rather than emotionally. This could mean shifting resources to a more profitable product line, renegotiating contracts, or weathering a temporary downturn without panic. Without controlled cash flow, even a small disruption can cause a major crisis. Finally, controlled cash flow is not just a financial tool, it is a leadership principle. When you run your business with financial clarity, your team senses stability. Your suppliers trust you. Your investors feel confident. You become the kind of leader who makes decisions from a place of strength, not fear. You understand that the purpose of cash flow control is not to restrict your growth, but to make sure your growth is sustainable, predictable, and strong enough to stand the test of time. One of the most common mistakes entrepreneurs make is mixing business and personal finances. At first, it might feel harmless. You think, I'll just use this account for both, it's simpler, or I'll pay myself back later. But over time, this habit becomes one of the fastest ways to drain the strength of your business. When the lines between personal and business money are blurred, you lose the ability to see the true financial health of your company. You start making decisions based on incomplete or misleading information. And that is when trouble begins to grow quietly in the background. Separating business and personal finances is not just an accounting decision. It is a mindset decision. It's about treating your business as its own living entity separate from you, even if you are the sole owner. Your business has its own needs, its own obligations, and its own growth plan. When you dip into business funds for personal expenses, you are taking away from the resources that should be fueling that growth. You may not notice the damage immediately, but over months and years, the impact compounds. The equipment upgrade you postponed, the marketing campaign you couldn't afford, the employee training you skipped, these missed opportunities often trace back to undisciplined handling of funds. When your business and personal finances are separated, you gain clarity. You know exactly what your business earns, what it spends, and what it keeps. You can measure performance accurately and see trends over time. You can identify problems early because you are not trying to sort through a mess of mixed transactions. This clarity is what allows you to plan ahead, make informed investments, and steer your company with confidence. Without it, you are flying blind. Another reason this separation is so important is because it helps you establish a healthy payment structure for yourself. Many entrepreneurs pay themselves inconsistently, taking more when the business is doing well and taking nothing when times are tough. While flexibility is sometimes necessary, it should not become a habit. By setting yourself a fixed salary from the business, you create stability in your personal life while allowing the business to operate on predictable expenses. This approach also keeps you from pulling too much out of the business during good months, which can leave the company underfunded when challenges arise. There is also a psychological effect at play here. When you keep your finances mixed, it becomes far too easy to justify personal spending in the name of the business. You might say, this trip is for networking, when it's mostly a vacation, or I'll just get the nicer office furniture, when it's really a personal indulgence. Over time, these justifications add up, and you start to erode your own discipline without even realizing it. Separating your finances creates a barrier that forces you to think twice before making these kinds of decisions. On the flip side, mixing finances can also cause you to neglect your personal needs. If you're constantly reinvesting every bit of money into the business without properly paying yourself, you may find your personal life under strain. Financial stress in your personal life can cloud your judgment in your professional life. You might take unnecessary risks or make short-term decisions just to cover personal obligations. A clear separation ensures that both areas, your personal life and your business, are funded and managed responsibly. From a legal and tax perspective, separation is not just wise. It's often necessary if your business is structured as a corporation or limited liability company. Mixing finances can put your personal assets at risk. It can also create headaches during tax season, making it harder to claim deductions accurately or defend yourself in the event of an audit. Even if you are operating as a sole proprietor, maintaining separate accounts simplifies your record keeping and strengthens your credibility with banks, investors, and partners. But beyond the technical and legal benefits, there's a deeper reason to keep business and personal finances apart. It builds a culture of respect for the business. When you treat your company's money with the same seriousness as you would if you were managing someone else's investment, you make decisions more carefully. You think like a steward, not just an owner. You understand that the business is a vehicle for your long-term vision, and protecting its financial integrity is part of your responsibility as a leader. This discipline is especially critical during growth stages. As your business starts to earn more, the temptation to blend finances can grow stronger. You might feel you've the wide, that personal splurge because the company is doing well. But those growth periods are exactly when you need to reinvest the most. Expansion requires capital for hiring, capital for technology, capital for scaling operations. Every personal withdrawal during this time slows that momentum. Ultimately, separating business and personal finances is about building a foundation for sustainability. It is about ensuring that your company has the resources it needs to survive downturns, seize opportunities, and expand into the future without being weighed down by personal financial habits. It protects your business from unnecessary strain. It protects your personal stability from the ups and downs of the market. And it allows you to operate with the clarity and discipline that every sustainable business demands. Budgeting and forecasting are often seen as tedious tasks. Numbers on spreadsheets, charts that only accountants get excited about. But in reality, they are two of the most powerful tools a business can use to stay healthy and grow sustainably. A budget is not just a list of expenses and income. It is a statement of priorities. It tells you where your money is going before it leaves your account. Forecasting is not just a guess about the future. It is an educated projection based on data, trends, and experience. Together, they form the foundation of financial discipline because they replace uncertainty with intentionality. A well-prepared budget forces you to think ahead. It makes you ask the right questions before the year or quarter begins. How much will we allocate for operations? What percentage should be set aside for marketing? How much can we afford to invest in research and development? By answering these questions in advance, you prevent emotional decision making in the heat of the moment. Without a budget, spending is reactive. You buy because there's money in the account today, without considering what might happen tomorrow. With a budget, every expense is measured against the plan, and the plan is built to serve the long-term vision. Forecasting, on the other hand, gives you the ability to prepare for what's coming. It is like having a map before starting a journey. If you know that certain months bring higher revenue, you can plan big projects during those times. If you know that certain seasons are slower, you can tighten spending and protect reserves in advance. Forecasting turns unpredictable challenges into manageable situations because you saw them coming. It doesn't mean you can predict every detail. No one can. But it means you are not caught off guard by patterns that could have been anticipated. When budgeting and forecasting are combined, they create a cycle of awareness and adjustment. You set a plan, you track actual results, and you adjust as needed. If revenue is lower than expected, you can scale back on non-essential spending before the problem grows. If revenue is higher than expected, you can decide whether to reinvest the extra funds or add to your reserves. This constant monitoring and adapting keeps your business agile, even in changing market conditions. One of the biggest mistakes businesses make is creating a budget once and never revisiting it. A budget is a living document. It should be reviewed regularly, monthly or quarterly, not just to check whether you're on track, but to update it based on real-world changes. New opportunities may arise, competitors may shift strategies, or economic conditions may change. If your budget remains static while the world moves, you risk being out of step with reality. A disciplined leader uses the budget not as a constraint, but as a compass, adjusting course while keeping the destination in sight. Budgeting also brings a sense of accountability. When you set clear spending limits for different areas of your business, you create a framework that keeps both you and your team responsible. Departments know what they have to work with, and they learn to innovate within those limits. Scarcity often sparks creativity. When resources are not unlimited, you are forced to find smarter, more efficient solutions. This accountability builds a culture where every dollar is respected and every expense is justified. Forecasting has an equally important cultural impact. It shifts the mindset of the team from reactive to proactive. When your people understand the expected flow of business, they can align their efforts with the bigger picture. Sales teams know when to push harder. Operations teams know when to prepare for increased demand, and finance teams can ensure that cash is available when needed. Everyone is moving in rhythm with the same forecast, reducing last-minute surprises and unnecessary stress. Another critical role of budgeting and forecasting is protecting against financial shocks. No matter how strong your business is, there will be periods of disruption. Economic downturns, sudden market changes, supply chain issues. Businesses without a budget and forecast respond to these situations with panic, often making drastic cuts or taking on risky debt. Businesses with disciplined financial planning respond with strategy. They know which areas can be trimmed without harming core operations. They know which reserves can be tapped to keep things running. They know how long they can operate under current conditions before changes must be made. This clarity turns a crisis into a challenge instead of a catastrophe. Finally, budgeting and forecasting are tools of opportunity, not just survival. When you have a clear financial plan and a realistic view of the future, you are in a position to move quickly when opportunities arise. A competitor's product fails and the market is open. You can invest in capturing that market because your budget shows where funds can be reallocated. A new technology becomes available that can double your efficiency. You can move on it because your forecast shows the potential return. Businesses that operate without these tools miss opportunities simply because they cannot see them or are too financially unprepared to act in business. Profit is often celebrated as the ultimate victory. But the real question is what you do with that profit once it arrives. Too many business owners treat profit as a signal to increase personal spending, upgrade their lifestyle, or make flashy moves that look impressive but do little to strengthen the company. Sustainable businesses understand that profit is not just a reward, it is a resource, and the most powerful way to use that resource is to reinvest it back into the business. Reinvesting profits is the discipline of turning today's earnings into tomorrow's opportunities. It is the difference between a company that plateaus after a few good years and a company that continues to grow, expand, and dominate its market over decades. When you reinvest profits, you are essentially planting seeds for the future. Instead of pulling resources out of the soil, you are feeding them back into the ground so that next season's harvest is even greater. This reinvestment can take many forms: upgrading equipment to increase efficiency, expanding your product line, improving customer service systems, hiring skilled talent, enhancing marketing strategies, or developing new technologies. Every reinvestment should have one purpose: to strengthen the foundation and capacity of the business so it can generate more value, more revenue, and more stability over time. The temptation to divert profits away from reinvestment is strongest during good times. When revenue is high and cash flow is strong, it's easy to feel that you've earned the right to spend more personally. And while rewarding yourself for your hard work is not wrong, the danger comes when lifestyle upgrades consume too much of the profit. What starts as a celebration can turn into a habit, and before long, the business is starved of the capital it needs to grow. This is why disciplined leaders set a clear reinvestment percentage, a commitment to direct a portion of profits toward growth every single year, regardless of how tempting it may be to use it elsewhere. Reinvesting profits is also an insurance policy against stagnation. Markets evolve. Customer preferences change. New competitors appear. Technology disrupts entire industries. If you're not consistently improving and innovating, you're falling behind, even if it doesn't feel that way in the short term. Many companies have failed, not because they ran out of customers, but because they ran out of relevance. They stopped reinvesting in product development, in their people, in their processes. Eventually, someone else came along who had kept improving, and the market shifted away from them. A smart reinvestment strategy also builds resilience. By using profits to diversify your offerings, expand into new markets, or strengthen your operational infrastructure, you make your business less vulnerable to single points of failure. If one product line struggles, another can carry the load. If one market slows down, another can pick up the slack. This kind of stability doesn't happen by accident. It is built intentionally over time through disciplined reinvestment. Another overlooked benefit of reinvesting profits is the message it sends to your team, your investors, and even your customers. It tells them you are committed to the long game. It shows that your decisions are not driven by short-term gain, but by the vision of building something lasting. Employees feel more secure knowing the company is using its success to grow rather than deplete itself. Investors have more confidence when they see profits being channeled into value-generating assets rather than disappearing into personal spending. Customers benefit when they see a business continuously improving its products and services. Reinvestment also compounds over time. The first year you invest in better equipment, you might see a modest increase in efficiency. The second year, you invest in skilled staff who can use that equipment to produce more. The third year, you reinvest in marketing that brings in a larger customer base to take advantage of your improved capabilities. Each reinvestment builds on the last, and after several years, the results are far greater than if you had simply taken the profit for personal use. But to do this well, reinvestment must be strategic. Not every use of profit is a growth investment. Spending on unnecessary office upgrades, oversized headquarters, or prestige projects that don't align with your core business may look like reinvestment, but in reality, they drain resources without increasing capacity or profitability. True reinvestment focuses on areas with a measurable return, whether that return is in revenue, cost savings, market share, or customer loyalty. The mindset behind reinvesting profits is patience. You are willing to delay personal gratification for the sake of a bigger reward later. You are willing to see your lifestyle grow slowly while your business grows rapidly. This patience is rare, which is why so few businesses become truly sustainable over decades. Those that do are led by people who understand that profit is not an exit. It is fuel. It is not the finish line. It is the starting point for the next race. And the more you put back into the engine, the farther and faster your business will go. Financial discipline is often tested not in the moments we expect, but in the extremes, when there is either more money than we anticipated or far less than we need. Most people think discipline is only for the lean times, the moments when every expense has to be justified and every decision must be carefully weighed. But the truth is, both abundance and scarcity demand the same principles. The temptation simply changes shape. In scarcity, the danger is desperation. In abundance, the danger is complacency. The leader who understands this knows that financial discipline is not seasonal. It is a constant habit, a way of thinking that holds steady regardless of the conditions. When times are scarce, financial discipline is about survival. It's about cutting what isn't essential, protecting the core of the business, and making sure that every rupee, dollar, or euro spent is tied directly to keeping the doors open and the engine running. Scarcity forces clarity. There's no room for luxuries, no budget for waste. It is in these moments that leaders often discover just how many unnecessary expenses have crept into the system during the good times. A disciplined leader does not panic in scarcity. Instead, they shift into a mode of calculated preservation. They protect reserves, renegotiate terms with suppliers, and make tough but strategic decisions to keep the business alive without compromising its future potential. But abundance brings its own test. When sales are strong, when the bank account is full, and when cash flow feels endless, discipline becomes harder to maintain because the urgency is gone. Leaders begin to feel that they can afford to take risks they would never consider in leaner seasons. They approve bigger budgets, hire faster, expand into areas they haven't fully researched, or take on unnecessary overhead because the money is there to cover it, at least for now. Abundance often masks inefficiency, allowing waste to grow unchecked until the market shifts and the reality hits. The disciplined leader understands that the habits formed in scarcity must be preserved in abundance. Just because you have more does not mean you should spend more without purpose. In both abundance and scarcity, the principle is the same: money must serve the mission, not the moment. This means that in abundance, a portion of resources should be set aside as a buffer for the future, reinvested into growth opportunities that strengthen the foundation and used to eliminate vulnerabilities that could harm the business later. In scarcity, the same focus applies, but with even greater selectivity. Every decision is measured against the question, does this move us closer to stability and strength? If the answer is no, it doesn't get done. A disciplined approach across both conditions also builds resilience in the team. Employees notice when leadership stays consistent regardless of market conditions. In tough times, they see a plan instead of panic. In good times, they see a vision instead of reckless spending. This steadiness builds trust, and trust is a competitive advantage. When a team believes the business is being managed with wisdom, they perform better because they feel secure about the future. It's also worth noting that the cycles of abundance and scarcity are natural. No business, no matter how successful, experiences constant upward growth without fluctuation. Markets shift, consumer behavior changes, and economic environments evolve. Leaders who adapt discipline in both conditions are never caught off guard. They know that abundance is temporary just as scarcity is temporary, and they plan accordingly. This mindset prevents overreaction in either direction. Instead of cutting too deep during scarcity and damaging the business, they make measured adjustments. Instead of overspending in abundance and inflating costs beyond sustainable levels, they stay focused on efficiency. One of the greatest benefits of applying discipline in both situations is the ability to act from strength rather than fear. In scarcity, disciplined leaders can make decisions knowing they have reserves and a plan for recovery. In abundance, they can invest aggressively in opportunities because their finances are already under control. In both cases, they are proactive rather than reactive, setting the pace instead of letting circumstances dictate their moves. The real test of financial discipline is not whether you can be careful when money is tight. That's often forced upon you. The real test is whether you can be just as intentional when the pressure is off. Abundance will tempt you to loosen your standards. Scarcity will tempt you to abandon your long-term vision for short-term relief. The leader who can navigate both with the same principles, the same patience, and the same focus on the bigger picture is the one who builds a business that doesn't just survive a season, but endures for generations. Financial discipline is not a tactic you apply only when circumstances demand it. It is the backbone of every sustainable business, the silent force that supports growth, protects stability, and ensures survival through both prosperity and hardship. It is the ability to align every financial decision with a clear vision, to control cash flow with precision, to separate business and personal resources so clarity is never lost, to use budgeting and forecasting as tools for intentional action, to reinvest profits as seeds for the future, and to maintain the same standards of discipline, whether resources are scarce or abundant. The businesses that endure, the ones that grow stronger with time, are not always the ones with the biggest ideas or the fastest growth. They are the ones whose leaders master the art of stewardship, protecting the present without sacrificing the future, and building the future without jeopardizing the present. Financial discipline is not about restriction. It is about empowerment. It gives you the ability to act from a position of strength, to weather storms with confidence, and to seize opportunities with clarity. When it becomes the guiding principle of your business, you move beyond survival and into a position where your success is not an accident, but the inevitable result of choices made with purpose, patience, and vision.